Okay, I think should be okay, right? Um, Something like that. Okay. So all I just got to do is tweet it out. Uh, Okie dokies. Okie dokies. Seems like we have uh it working. Okay, perfect. So welcome everyone to Investing 101. How to make tendies by taking calculated risk. So this whole video and this whole live stream will be about trying to have a more methodical approach to investing in general. We're not going to, well, talk about, or, okay, we could talk about the GME stuff, but this is ultimately here so that for those that want to seriously invest for their future without going through all the risks that what we've seen in the start of this year, how to be able to actually do it in a very, very safe and reasonable way, right? So what I'm going to be talking about is really just the basics of investing at the current moment, as well as what you can do with that information to start investing, maybe just even now, for retirement and for savings for maybe a long-term goal. Okay. Oh, okay. Discord? Okay, so let's get going. So, if you want to just get with investing literally right now and you don't want to watch this video, and you want to make some tendies, of course, I'm going to have to give you the drill down. You literally just buy VEQT or XEQT if you want to maximize your gains and take lots of risk. Those risks are appropriately adjusted for the maximum amount of gains that you have. And those risks are also not like GME level risk, but they are risks where if the market goes down, you will go down. If the market goes up, you will go up. That's what I mean by risk in this case, with large amounts of risk. Most of the times, when the stock market goes up, so accordingly, will VEQT or XEQT. These are publicly exchanged. These are public exchange trade funds, or ETFs, really, that anyone can buy if on any sort of brokerage, and basically buy them and invest with them, and you literally can buy them constantly and never ever have to worry about selling these whatsoever until you retire. If you want to not take that much risk and be a bit more conservative, you just buy VGRO or XGRO. Basically, they're just VEQT or XEQT with bonds. And bonds are very important to helping stabilizing your investment. And if you'd like to, well, also stabilize your investment in a way where on ridiculous highs and ridiculous lows, you don't budge up and down as much as the market does. They can also really help during a market crash. So whenever a market crashes, generally you always hear that stocks go down. Bonds generally don't. And or if anything, they move down much more slower than stocks, which can help preserve your total investment. With that being said, VGRO and XGRO are a bit more conservative because they have those bonds. And if you feel a bit more like risk adverse and you want to make sure that you really don't take a lot of like losses during your investments, all you just got to do is buy these funds called ETFs called VVAL or XVAL. They, instead of having 20% bonds compared to VGRO and XGRO, all they really have is 40% bonds, right? So you're even more conservative. You put more proportion of your investments into bonds. Your gains aren't as high, but your losses aren't as high whatsoever, which is great. So that's the TLD you didn't watch. And if that's all you needed to know about investing because you just wanted to get over with, this is your slide. But if you would like to know a bit more about how the market works and a bit more about investing, do stick around and watch. Okay, next slide. So, and also a quick notice, I am not a financial advisor. I am a self-taught do-it-yourself investor, DIY investor. And so therefore, I'm not responsible for any financial decisions you make. And the purpose of this presentation is to just have a basis for an underlying information on just investing in general. So ideally, I'd hope that through watching this video, everyone is able to learn about investing in general if you are a complete newbie. And so you can take away something from this presentation in this video so that it can help you be more well aware of how the market works and how that plays a part in investing in general. With that being said, I am not responsible for any loss of money that you incur with any of the investments you make because that is your decision. What I'm trying to do is I'm trying to help people understand the market and investing overall holistically. Okay, so we got to ask ourselves, well, what is investing in the first place, right? Like everyone keeps on saying, I got to invest money in order to save up for retirement. But what does that mean? Like, does it mean just dumping your money into something to eventually get more money in the end? To some degree, yes, but here's a more detailed, formal explanation of it. There are more technical explanations of what investing is, but this is just basically a good rundown of it. Basically, it is taking your money, but it sometimes can be also other people's money in hope for an expected return over an expected period of time. So, like for example, I might invest $50 in Apple, and I expect when I buy those stocks of Apple, $50 worth of Apple, that I'll eventually get an expected return that is more than $50 after a certain period of time, right? So like if I want to hold on to Apple for 2 years and I bought it for $50, you'd expect that as an investor, as a person that you want to buy something that invests into Apple, to expect that $50 stock to rise up to something more than $50, right? It could be $51, it could be $60. And in some cases, they can go downwards, but that can happen depending on the type of investments you make and the type of business that you kind of invest in. So when more money is gained from an investment than is put in, that's called a positive expected return. And ideally, that's what everyone should strive for. That's the whole purpose of investing, because you want a positive expected return from your investment, right? If you invest your money and lose money from it, it's probably not a good investment whatsoever. And that's what we call a negative expected return, right? So for example, for a lot of people that bought GameStop, right at the beginning of the short squeeze, a lot of them had a positive expected return because they expected some money to be given back to them in terms of profit, but over a specific time period, that depends on the person. For some people that bought GameStop before the short squeeze, that they were able to buy they were able to buy GameStop at a relatively cheap price and the expected time frame is, well, was pretty short. And yeah, it went to the moon. Anyways, hey, what's up, replicant? But yeah, basically, for in this case here, what an expected return means is that basically you can buy any stock, and depending on the time period that you as an investor would want, you can expect an expected return of that's positive. Ideally, you want it to be positive of any type of value, maybe $10, $20, but generally it's expressed in percent. Real world case study, yeah. We'll talk about that later, definitely at the end of the presentation. But ideally, investing is, again, fundamentally, you're paying a set amount of money to buy a company and expect future profits in return. That's ultimately what investing is. Okay, so ultimately, with that being said, when you have something like a portfolio or you have an investment and you have multiple types of investment, generally we calculate expected returns with this type of formula. It's a bit of math, but it's not too complicated. We're going to explain it in English though. Your expected return is the weight of your security times the expected return of security. So let's just say I bought $50 worth of Apple and $100 worth of Microsoft. My weight of my security with Apple is 50 divided by 50 plus 100. So that would be a third. Times the expected return of Apple. So let's just say it made $10. 1/3 times $10 is $3.33. If I bought Microsoft and I invested $100 into it and it went up by $20, it would be $20 multiplied by 100 divided by 100 over plus 5. So that would be 2/3 times 20, which is roughly 13.3. So let's just paint it up. Okay, and we'll just type it out. So that would be expected return is equal to $50, or whoops, not $50, my bad, the weight of security. So that's 50, yeah, that's $50 plus 50 plus 100 times the profit. And let's just say we got $10 from it. Plus, and let's just say we bought Microsoft for $100, $100 plus 50 plus $100 is $20. And if I do the math in my head, that should be $3.33 plus 13.33. And that means I made a profit of $16.66 as my expected return. It's that simple. Okay, and there's my source, Investopedia. Investopedia is pretty good as a way to just get a brush up overview knowledge of investing and generally like what to expect. So if you're curious, definitely check them out. And so now we're going to be talking about calculating rate of return of investment, or basically the ROI. ROI is basically the total amount, while expected return gives you the total amount in dollars exactly of your investment. The rate of return on investment is actually the percentage of your investment. This gives you it's basically a percentage of your principal, and the end of your total your end total investment. So basically, it basically gives profit as a percentage, right? So for example, let's just delete this. Again, let's use the same example. I made $10 on Apple, and I spent $50 buying Apple shares. Multiply that by 100, and I made a return investment of 20% on Apple. That's simple. So it helps this. So the thing is, with calculating return on investment, it actually has its advantages to that of calculating expected returns. When you know your rate of return on investment, and you compare it with other returns on investments, what that means is that it helps you gauge what investments may be much better than others in terms of how much money you get in the end. Because ideally, you want to pick the investment that returns you the most amount of money for how much you invest into it. So ideally, while expected return is great because it gives you the dollar amounts, what really matters in terms for an investor is the return on your investment, right? Because that ultimately means that that's where you should put most of your dollars into in order to be able to accumulate the most amount of wealth, right? So with that being said, this all comes at a caveat. And one thing that I must emphasize is that when you're buying these type of investments, when you're buying these securities, you're being sold these securities at a discount. Because if you were, and if you wanted to make a profit, that means that the thing that you bought must be cheaper than how much than you sold it for, right? It's kind of common sense. If I buy something at $10 and I sold it at $10, I don't merely make any money. I just waste my time and I make $0 profit. So with that being said, to make a profit, you have to be sold something at a discount, right? So when you're seeing an investment and you're seeing stocks go down, what that means is that people's returns on their investments obviously were not at a positive number. They were at a negative number. And what in actuality happened was that they did not buy the stock at a discount, but they overbought the stock. The stock was actually overvalued, if that makes sense. And one big thing that helps understand why stock prices can be so low is because of the given risk. There's a chance that the stock price may go up or down. There's no guarantee of it. And that is inherently risky in investing, right? Some companies, when you invest in them, may have more risk than others. Some may not. For example, a lot of people may hear that Costco tends to be a pretty non-risky investment because it very rarely goes down. It generally always goes up. Therefore, given the risk of Costco, you would expect it to be pretty low and therefore the price to not really be at a high discount. Generally, whenever the stock is riskier, the stock is cheaper to buy. But when it's cheaper to buy, there's no guarantee that the price of the stock will go upwards and to the moon. So there's always that to take in consideration when you're investing. So when you're investing into the stock market, when you buy anything like a stock or a bond, you are basically buying something called in the technical sense a security, right? And so there are two types of securities that you can really buy in the stock market. They're called equities and debts. Equities basically is a stock. So I'm just kind of reiterating terms here, but essentially what it means is that you own a portion of a share and you own a portion of your future profits. On the other hand, that means securities like bonds and guaranteed payments back to the buyers at a fixed amount for a set period of time. So things like GICs, government insured corporate, I think it was not government insured something. I can't remember exactly what it was, but it's basically you lending money to the government and the government is promising to pay you back a certain amount of money in the future. Or you could buy even corporate bonds where instead of lending money to a government, you lend money to a corporation in order to get return on your money back. And unlike stocks, this is guaranteed. So bonds are for the most part always safer than stocks, right? On top of that, investors or you as a person can buy something called an exchange trade fund, which is basically a collection of securities. So a collection of stocks and a collection of bonds. So for example, buying Tesla is basically owning the stock itself. But buying something like the ARK Innovation ETF, ticker symbol ARKK, is basically owning a collection of stocks that includes like GameStop or Tesla. And that is a typo, so I will fix that in the future. So there are three things that you can buy: securities, or things that buy a group of securities called ETFs. And essentially ETFs are, because they buy a collection of securities, you basically perform the action of buying those securities, but in just one action, right? So it could save you a lot of time. So there are differences also with buying securities versus buying ETFs, right? Securities, again, being stocks and bonds, and exchange rate funds being a collection of those stocks and or bonds. So with securities, like stocks and bonds, you basically directly own the security you buy. So if you buy a stock, you own the stock. Like it's yours. But on top of that, there are no fees for owning securities. You don't pay anything extra for just having a security in your account. You're also in control of how much stocks and bonds you want a percentage wise in your portfolio. So you might want to have 33% Apple or 66% Microsoft, or maybe you want 50-50. You can do that with securities, like by buying directly stocks and bonds. You can't necessarily do that with exchange trade funds quite easily. In fact, it's pretty hard to do it with that. Also, gains and losses are much more impactful on your investments because you own the security directly. Because you own Apple and Microsoft directly, and those stocks directly, you are essentially going up and down with those stocks, right? Just because if they go up $1, you go up $1. If they go down $1, you go down $1. So they can exaggerate, not exaggerate, but they take the full brunt of any sort of gains or losses that you may incur. As well as they're often used pretty more risky because of that matter. And with that being said, they're often used by swing traders, people that buy and sell on a weekly or monthly basis, or they have short or mid-term like financial goals. On the other hand, exchange traded funds again are collections of stocks and bonds, and you do not own any securities you buy. The person managing the fund does. So if I buy, like again, ARK, right? I do not own GME or Tesla. It's the person that manages that fund that owns GME or Tesla. I just buy a portion of a collection of that collection of securities, and it's them that manages it all. So they own the stock themselves. I don't. All I do is I own a portion of the collection of funds of securities that they have. I don't have a say in how that company works if I buy like 50.101% of the company. Right? Okay. On top of that, there are fees that are incurred for owning an ETF, and that's actually how fund managers get their salaries. When you buy an ETF, someone has to manage all those collections of stocks and bonds in the form of something called management expense ratio, or MER, right? So that's how they get paid, and that's an inevitable with all exchange trade funds. They always have a percentage of their profits being paid to the person that manages those funds. Again, that's called the MER. With exchange trade funds, they are slightly harder to get the percentage of securities that you want because ETFs have a lot of securities on them. For example, if we bring up this here and we look at an ETF called Vanguard Equity All Equity ETF Portfolio, we see here that if we open up the allocation of companies, here we have 1,482 stocks in this one fund. So what that means is that you don't have a say in exactly what percentage of this stock is in this portfolio. The fund managers do. The people that are managing these exchange trade funds does. Gains and losses are also affect your investment less because you have a mix of securities. So if we go back to example of owning Apple, Microsoft, Apple is only 1.9% a portion of this exchange trade fund. So if Apple goes up by $100, this exchange trade fund VEQT goes up by 1.9% of $100. Basically, it goes up by $1.90. So your gains are also capped based off of the percentage of the market value within that portfolio. Okay, as well as your losses too. So it goes both ways. With that being said too, they are also considered less risky and used by long-term hold traders, people that buy and very rarely sell, mid or long-term investment goal, basically for mid or long-term investment goals. So if you're planning on basically retiring with investing, you generally want to buy exchange rate funds because they are less risky, because there's a buttload of companies within them, and the chances of them one going down while still is quite low. If one does go down, it really doesn't affect your portfolio that much. So there's incentive with exchange rate funds, with people that want to invest long term to buy exchange traded funds, because they are very safe in terms of their investment because they own so many stocks, right? So with that being said, should you buy an ETF for security? That really depends on your long-term goals. But here's the general rundown of it. Buying a stock is risky because you are literally putting your eggs in one basket. You are putting your investing dollars, your own money, into a company that you hope that will go up and down, right? On the other hand, ETFs will allow you to invest into a group of stocks to form a set of stocks targeting maybe as like a specific industry. So for example, let's just say you want to buy technology stocks. You don't have to just buy Apple, Microsoft, and every single technology stock out there by yourself. You can specifically buy ETFs that target that. So for example, there's an ETF called Tech, right? It's basically the TD Global Technology Leaders ETF. And if you search up into their fund sheet onto the portfolio, okay, we will have to wait for a little bit. Okay, maybe if it's not loading up, I will open up another page and we look at all its holdings. We can see the top 10 holdings are Apple, Microsoft, Amazon, Facebook, Alphabet, double classes. That is a bit of a tricky one. Tesla, Visa, Nvidia, and MasterCard. And these are the percentages that take up tech in its portfolio, right? Okay, the page went up. And if we see here, we will have to check its holdings. Generally, it's available right here. List the full holdings. And you get a rundown basically of all the companies within that ETF. So that's one of the benefits for using ETFs. You can target specific areas of the stock market that you want. HBK? What's HBK? But essentially, with that being said, like exchange trade funds are great because if you really believe in technology, like being a major part in the stock market, that will return like really good returns. You can buy an ETF instead of just buying all the stocks yourself one by one, right? Of course, it's for a fee because someone has to do it for you, but generally it saves you a lot of time and it's worth it. Another example is basically like if you want to buy semiconductor ETFs, right? iShares PHLX semiconductor ETFs, ticker symbol SOXX, buys a set of companies producing semiconductors. What that also means is that if you don't really have to pick out the winners within a stock. Maybe Apple might do better one year than Microsoft, or Microsoft might do better than one year than Apple. All you need to do is buy an ETF to basically just own the sector rather than having to pick favorites within that sector. And like I said, buying stocks is risky because you are putting your eggs in one basket. You are essentially betting on the fact that one company may do better than the other. It is often easier to work with. ETFs are generally often easier to work with as you watch over a specific industry or group of companies, allowing you to do more holistic analysis rather than more in-depth analysis of a company. And this is one thing that's also nice about ETF. Instead of saying, I'm going to think that Microsoft's going to do well, it's easier to say, you can just ask yourself, I think the technology industry is going to do well. And generally, with that being said, it's easier to assume that the technology sector will do better than one single company within that specific sector. The more specific you have to be about whether or not your choices to invest in, generally the riskier it is. So ETFs, by its very nature, is inherently less risky than stocks. Also, ETFs introduce diversifications easily into your portfolio if companies are in different countries and even in different sectors, right? Generally, it gets you the whole market around the world. And it is at a fee because, again, you have to pay someone to do it, but it is ultimately quite negligible. So with that being said, maybe you might find a tech company in like Japan that's like really good. Like maybe you want to buy Honda, or then you might want to buy like Ford, also, but that's in the US. You can buy an ETF that buys automakers, right? So there's that to help you out. That's ETFs. And so you're kind of understanding where I'm coming from. ETFs are pretty good. They're generally better than stocks. Also, on top of that, ETFs are pretty much cheaper than the underlying stocks that hold within them. So for example, if I wanted to buy Apple right now, today they closed at $133. That's a lot of money. And that's in USDs, right? But if I wanted to buy Vanguard Equity All Equity BEQT, Vanguard All Equity ETF portfolio, it's only $33.70, right? So, and not only that, like it's significantly cheaper than Apple. Again, VEQT does have Apple within it, and it's buying the ETF of Vanguard VEQT. The fact that it's cheaper than Apple means it's a lot more approachable to buy than a straight up Apple stock, right? So there's that going for ETFs. Did I also mention diversification? Diversification helps mitigate the risk and potential downturns in your investment by adding multiple factors and aka stocks in your portfolio. So, like I said, sometimes one company may do better than another company in a sector. By buying an ETF, you help mitigate the losses that you have available in your portfolio. So on a more technical level, basically, if you really look into the math behind it, they help mitigate your risk while keeping your overall long-term expected return the same. To be able to mitigate your risk without affecting your potential upside earnings is considered a very good investment. If you could earn $100 but risk losing $50 over losing $100 gaining $100, you'd probably take the option where you can lose $50 but gain $100, right? That's essentially kind of what ETFs do. They help mitigate and lower your risk, but keep the same returns. So, from a logical perspective, your returns really don't change, but you lose a lot less if things go sour. So why wouldn't you? And that's what ETFs do. So it would make more sense to buy an ETF than buy stocks directly. So with that being said, again, what are stocks? We know that they are basically a portion of your ownership in the company, as well as this expected future profit that the company makes. And it's at the price at which you buy it at, right? Remember that when you buy a stock, it's generally at a discount, right? You expect to buy it at a cheaper price than what you expect to get it in return in order to be able to make a profit. Sometimes the expected future profit the company makes gets paid out in dividends too. Sometimes it's paid out and reflected in a higher stock price. So generally, when you buy stocks, sometimes stocks can pay out things called dividends, where they give you money every year, every quarter, or even every month. But that's the price of to pay out that dividend. That dividend has to come out from somewhere, and that's actually generally reflected into the stock from the stock price. When you see a stock going down but still pays a dividend, what that ends up meaning is that they take the price of that stock and they pay out their shareholders. So with that being said, for a stock to be worth it, the stock should pretty much still go up in general. If it's not paying dividends. If it is paying dividends, then it's a bit harder to calculate, but in general, that's what it should do, right? No one can really predict the future and know whether a stock will go up and down. And there's no guarantee the stock will go up. But we can learn more about companies we invest in, either through financial news, financial papers, or balance sheets, corporate activities, and all that like. And based off of those, we can make informed decisions to believe whether or not a company is worth what it's priced at. Basically, it's a valuation, right? So what it means is that when you buy a stock, you are technically gambling on and taking a bet on whether or not that stock will do well. But to make an informed decision on whether or not that bet is a good bet to make, what you have to do is you have to do something called due diligence, and to be able to understand financial papers, what the company may be doing on a fundamental level, to be able to understand whether or not the company is really worth what you're buying it at, right? And then again, you're buying it at a discount. So when you're doing your due diligence and you're researching on a company, you expect them to make a profit based off of an action that they've done, or to basically be less debt. And so now we have to ask ourselves, well, okay, what are bonds? Bonds are sometimes called fixed incomes when you invest. Sometimes they are a contract between two parties where one lends money to another member of the party in exchange for a fixed amount of money later in the future. And again, they are generally given out by the government, but they can be also given out by corporations as well. Because bonds have an expected returns, because you're guaranteed to get that money at the end of your term, these prices of these bonds are attractive for those that want some stability in their portfolio. If you have guaranteed returns in your investments, why wouldn't you want to take it? It's a lot more better than taking risk. With that being said, generally a safer expected returns means that more people are looking to eye on that stock or eye on that security, right? So that also means that for people to get that security, they're willing to pay a higher price for that bond. So, for example, let's just say you want to buy a $1,000 bond from a government for 2 years, and they'll give out $150 at the end of those 2 years. Sometimes, instead of people buying it for $1,000, they buy it for $1,025 at the beginning. So the potential profits is actually $25 instead of $50. But because it's guaranteed, like, people are willing to pay that premium for that bond. So with that being said, due to their nature, they're basically the opposite of stocks. They're not risky whatsoever. And then when stocks tend to go down, bonds tend to kind of go up. They usually they're great for people that are near retirement, or that people that just want to stabilize their growth within their growth in the market with their investments whatsoever. With that being said, just like stocks, where you can buy an ETF, you can actually buy ETF of bonds, right? So you can actually buy a group of bonds, a collection of bonds. One example may be the Vanguard US Aggregate Bond Index ETF. That's Canadian hedge, called VBU. So that's, if you search it up right now on Google, yeah, they are basically a collection of bonds, and they move on the same level as which bonds appreciate at. So with that being said, now that I talked about all this freaking jargon, how the hell do you even buy these securities on the stock market, right? Like, sure, you can buy a stock and a bond and an ETF, but like, how do you do it? Do you just give it money to a bank and do it? Not so fast. First, you have to go through something called a brokerage. So what are brokerage? Brokerages are just basically the middleman between the buyer and the seller. They facilitate the transaction between you, the investor, as well as the seller. Maybe it's the government, the company, if you're buying bonds, if you're buying stocks. So for example, one of them may be Questrade, Wealthsimple, Interactive Brokers, major banking trading platforms like TD Direct Investing or Scotiabank's iTrade, or even companies like Robinhood, right? All of these are called brokerages, and you can sign up with any one of them to start investing. It's really pretty simple. So every brokerage has their pros and cons based off the fees that you're buying and selling securities. So with that being said, again, someone's managing these brokerages, they have to get paid somehow. And for them to make a profit for managing these brokerages, they need to charge you fees. Where they charge you fees also can affect you and influence you to choose one brokerage over the other. Based on the number of securities you can buy, you may have to pay different fees on one platform over another platform. So for example, when I was with Wealthsimple Trade, I basically paid no fees on any ETF or stocks or bond listed in Canada. But if I ever wanted to buy anything across the border, down in the US, I need to pay a 1.5 conversion fee, foreign exchange rate, to buy and sell ETFs in the US. On the other hand, I'm also with Questrade, and while they charge a 1.5% conversion fee to convert your money from Canada to the US, and they also charge a 1%, a penny per unit when selling their ETF, often because I am able to only pay that fee when I sell with Questrade instead of Wealthsimple Trade, where I have to pay that 1.5% conversion fee both ways, both buying and selling. Often for me, Questrade is the right brokerage for me to trade in. So based on this information, you will have to make some foresight with your investing that when you make that investment, because you want to ultimately avoid the amount of fees that you incur from doing these type of trades when we're buying, selling, and selling securities. And sometimes the fees can be higher with one brokerage over the other. Some platform can also be better. With that being said, with all these take into consideration all these fees, some platforms may be better to day or swing trade with due to the lower fees. Some are better based off other criteria like better user interface, customer support, the things that aren't tangible, that really don't affect your like investment overall, but can make the experience just a little bit better, right? So for example, like major banks tend to charge higher fees for trading. They charge generally a flat fee of $10 whenever you make any sort of buy or sell of any security. Unlike other institutions like Wealthsimple Trade or Questrade that are often much cheaper. And usually fees from major banks, again, are flat. So with that being said, regardless of how much securities that you buy from when you make a trade, you generally pay a flat $10 fee. But on the other hand, when you are with other institutions like Wealthsimple Trade or Questrade, they charge a variable flat rate, right? So they change the amount of fees you get charged with changes with the amount of securities you buy and sell. With that being said, major banks have the convenience of connecting your checking account with your investing account seamlessly. Other institutions like Wealthsimple Trade or Questrade often have to make you wait a few days before receiving money to invest with, generally through just transferring money from one institution to another institution. So with that being said, dealing with thousands of volumes of trade and units of securities bought and sold makes major banks ideal, while smaller amounts make other institutions like Wealthsimple Trade and Questrade a lot more better. So in general, you want to stick with those smaller other institutions like Wealthsimple Trade and Questrade when you start out until you have a lot of money to make investing with major banking platforms worth it due to their high fees. So with that being said, selling with brokerages is honestly pretty easy. All you literally do is go on their website, open an account, and then you get to this page. You get these types of accounts. Like, what? I thought, maybe you might think, oh, there's only like one type of account that you invest with. No, there are lots of types of accounts actually. And depending on how experienced and how well-versed you are in investing, as well as where you are in investing, there is an obvious choice to which type of investment account that you need to invest with. So basically, there are two types of investing accounts that you just really need to worry about. Non-registered accounts or taxable accounts, and registered accounts or non-taxable accounts. Kind of flip-flop. And non-taxable in quotations because there can be some limitations. When you invest with a non-registered taxable account, you put money to invest into ETF security. Normally just like you'd expect with what you hear about on the TV and on the movies about people, you just put money in and you start investing. With that being said, because it's taxable, what it means is that any profit you made by selling off securities is called capital gains, or via dividends. Oh, I missed a sentence there, but essentially, let me cancel that, and are taxed. Okay. They are taxed, right? So with that being said, if you made like $1,000, right, and you're in the first tax bracket, and you also make money by selling off your securities, you have incurred capital gains tax. You have made capital gains and you will incur capital gains tax, and you will be taxed on that profit, right? Money invested into securities and ETFs are taxed at your nominal tax rate. So depending on whatever tax bracket you make, like sometimes working with the tax bracket untaxable account may be good or maybe bad. Generally, you want to avoid it at first though, because you generally don't want to get taxed on your income. So regardless, no matter with that being said, there is no limit really to how much money you can put in your taxable account, whatever. You can dump in your whole life savings if you want to. I really don't recommend that. Please don't. But you can put as much money as you want into your taxable account and invest with it, no problem whatsoever. On the other hand, with a registered account, just like a taxable account, you can put money into and invest into ETFs and securities. Profits made by selling off securities, called capital gains, or via dividends, are delayed at a future rate and are not, or sometimes even not, taxed at all. So for example, if you're in Canada, we have something called a TSFA, a tax-free savings account. Any investments made off of that tax-free savings account are not taxed whatsoever. If you made $1,000, you get to keep that $1,000 100%. If you were to make $1,000 in a taxable account, that $100, or I mean that $1,000, is going to get taxed, and you'll only get a portion of it instead. So ideally, taxable registered non-taxable accounts are ideal for investing. You pretty much, with that being said, you pretty much always have an annual maximum limit of how much money you can put in every month, and that's all dependent on your government, right? Yeah, PSA only invests the amount of money you can responsibly afford to lose. That is true. There is some workaround with it though, but in general, yes, that is the right PSA. Invest only the amount of money you can responsibly afford to lose. With that being said, back on track. With the registered account, you have a limit every year with how much money. That should be every year, not every month. Whoopsies. Okay. You have a maximum limit every year on how much you can invest with. So that's all dependent on your government. Please check with them to make sure you don't go overboard with it, because sometimes if you over contribute to your registered account, you will get dinged with taxes and fees, right? And on top of that, on top of what I just said, with registered accounts, that cumulative amount of money you can put every year, it's all cumulative, right? So you don't get, if you don't contribute this year, you can contribute next year on top of whatever contribution room the government states next year. It's pretty good. So ideally, with that being said, what type of account should you invest with? With a taxable account, you only want to deal with it when you really want to reduce your income tax. That will have to be another story for another day. It's also best done after maxing your registered accounts. And it also, and on top of that, it just has no favorable government preference. On the other hand, registered accounts are best done first, because before any other type of account, based on government incentives, your investments are sheltered under a registered account, can grow tax-free or tax-deferred. And with that being said, what that means is that your tendies that are not taxed lets you make more tendies from the interest that you make, and that those interest from those tendies can make more tendies. So you basically get tendiception. Ideally, if you can avoid getting taxed from your investments, and you can let your investments grow interest, those interests over time can build more interest because they're reinvested into your investment. So ideally, general rule of thumb, registered accounts first, then invest into non-registered accounts. It's that simple. If you're in Canada, invest into your TSFA first, your RRSP, and then work on a taxable. If you're in the US, I believe it is your Roth IRA, then your 401k, and then a taxable. I'm not American, so I don't know that 100%. You will probably have to double check that. Okay, so after all of that, you create your account and you're putting in your money. Congratulations, you can start investing. Now it's time to buy all these stocks, bonds, and ETFs that you want to invest in to basically start investing and to make all those tendies. But then you get onto this freaking page here, which lists all these symbols, all these companies, and all this data. And you're like, what the hell just is happening, right? This is a lot of information to take. So with that being said, what should you invest in? Whoops, the animation was a bit off. But what should you invest in? With all those options given to you, it's kind of hard to decide, well, really what to buy, right? If you really don't know what to buy at all, At any point in time in your investment, follow these simple rules. Buy VEQT, XEQT, or GEQT for maximum risk and highest return. Again, those risks are within accordance to the market, not some weird like other stock related risk like the company falling down, right? VEQT, XEQT, GEQT are reasonable maximum risk for the amount of highest return. If you're more conservative about that, buy VGROW, XGROW, or GGROW for close to maximum but safe risk, where you'll generally get the second highest return. And if you're even more conservative about that and you don't want to really like lose a lot of your money, buy VVAL or XVAL. Again, all the difference between the two is the amount of bonds they have. All these are ETFs and not stocks. I am not advocating actually for any stock picking whatsoever if you're new to investing, because unless you understand what drives the price of a stock and how the stock market works in relation to the economy, just because you feel good and the price is going to go up doesn't mean that the stock is a good buy. If you're in America and if you're an American citizen, VT or VTI for people with access to US listed ETFs. Those are the ones I generally recommend that anyone that is starting to invest should buy right off the bat and not waste their time picking stocks until they accrued enough money to lose while picking stocks. So with that being said, I've suggested a lot of broad market ETFs like VQT, XEQT, GQT, all these V, G, and Q, all these V, all these X, all these Gs, like basically what are they? They're basically ETFs, but they're considered a specific type of ETFs called broad market ETFs, right? ETFs like VEQT, VGROW, XVAL buy a ton of stocks around the world for you. Like it literally buys like 9,000 plus stocks, seriously, for a small fee. Buying one ETF is much more easier than buying an individual stock, which makes maintenance of your investments much more easier. If you have to worry about one ETF versus 9,000 stocks, I'm going to worry about one ETF, right? On top of that, it helps you capture gains elsewhere in the world, not just Canada and US, which can outperform the Canadian and US market. So, just to come back to that point, for example, if we were to search up global market annualized growth rate, and we search for a chart that shows by country, right? All these countries have their own growth rates, right? Their markets may grow more than others. It's not always the case that the US market and the Canadian market and other markets grow up quickly, right? So for example, like if you invest into Timor-Leste in stock market, their own country's stock market, your investments would have grown by 18%. Whereas compared to like maybe this is not a comprehensive list. Market annualized growth rate by country. Here you go. Here, like, where is the US? So for the wait, these numbers don't look right. Okay. Market index growth by country. So here you have a list of all the markets within the different countries, and they grow at a different rate. So for example, if we search by year to date, we see that the S&P Global 1200, so globally the world grew its markets by 21%. If we look at a specific country, we see here LUXX, which should be Luxembourg. So from last year, the Luxembourg market grew 19%, 15%, which is pretty ridiculous. If you had in your investments in Luxembourg at all, you would have captured those gains, right? Compared to like the US, where they have different indices, but the most popular one is the S&P 500, and they grew around by like 9.75%. So with that being said, while the US market is pretty stable with its market and generally always grows, it is not always the best market to grow in, which is why there's incentive to use broad market ETFs so you can get gains from the market around the whole world, which can outperform Canada and the US, right? And what it also means is that basically when you buy these broad market ETFs, you net just under market returns because generally around 6.5 to 7.5%. Less with bonds when you have like VGRO or XBAL. While actively managed funds like mutual funds tend to net between 2.5% on average annually, right? So with that being said, these broad market ETFs, while they buy literally every company in the world, they are not 100% accurate. So what it means is very likely you will get just slightly under market returns when you buy these broad market ETFs, which is still fine because in general, you get 6.5 to 7.5 returns annually when you buy these broad market ETFs. This means that when you buy these broad market ETFs and you do literally almost nothing, you will earn more than most active managers that have spent years in school trying to beat the market by buying the right stocks and bonds. Yeah, I am not lying about that. You will, just by buying this one single fund, beat the market. Pretty much not beat the market, but beat most active managers that have worked their whole lifetime trying to beat. It's that crazy and it's that insane, but these broad market ETFs are really that good. So if, for example, what I've done was that I've here made a portfolio of VEQT and SPY, and they're 100%, in VEQT and 100% in SPY. If I map this out, you see that the blue line is actually VEQT, and the red line is SPY. And you do get slightly under market returns at the beginning, but starting since 2019, especially during or before the pandemic, the US market was doing quite well, and so it has kind of taken off. But for the most part, you do get just under market returns with broad market ETFs. And again, this is VEQT, which is a broad market ETF, versus SPY. SPY is basically index fund that tracks the S&P 500. So with that being said, from this graph, you can kind of tell that the US market has been doing quite well for the past year or so. So there are some negatives with buying broad market ETFs, right? But there's very few that are ultimately detrimental to not even buying them. One is that sometimes stocks will outperform the market. If you do pick the right stocks and you do invest into it, your money into it, sometimes those stocks will overall outperform a broad market index fund because sometimes you might have made the right picks with your stocks. That's just the reality of it. With that being said, possible gains that can be made for investing into a few select stocks. Possible gains can be made by investing into a few stocks rather than an ETF. So with that being said, because you're buying fewer stocks by buying stocks individually, rather than buying a broad market ETF, any gains that those stocks that you made will greatly affect you and your investment, and therefore your overall portfolio. Whereas when you buy an ETF, because there's so many stocks in there, one stock going up doesn't really matter in the grand scheme of things, but a whole set of stocks will though. Also, sometimes the fees may be too high for a few ETFs depending on what type of sector you want to buy, right? So for example, if I want to buy financial stocks, but I don't want to go through the hassle of buying all these stocks individually, BMO and TD and Scotiabank, I could just buy an ETF for it. But with that being said, Canadian bank ETFs, if you look at Canadian bank ETFs, right? So one of them being ZWB, and we check the exchange MER, you can see here that the MER is quite expensive. It is 0.71. So with that being said, they take 0.71% profit for managing this fund for you, right? So that's what I mean by when the fees can be too high. On top of that, if I can recall, I remember seeing the holdings for this, and there's only like a few actual banks that they hold: Bank of Nova Scotia, National Bank of Canada, Canadian Imperial Bank of Commerce, Royal Bank, TD, Bank of Montreal, and BMO themselves. So basically, for managing these companies for you, you pay them 0.71% profit as a management expense ratio. Whereas if you really wanted to do this yourself and buy 7 separate ETFs, you don't have to pay that 0.71% whatsoever. So that's what I mean when I say the fees can be a bit too high. But it's dependent on the different type of sector that you buy it from, that you want to invest in. On top of that, you don't have a say in the type of companies that you like to invest in, if you want to consider its ethics. So for example, like if I wanted to buy, again, I'll go back to VQT. It owns 12,000 stocks. Maybe when one of these stocks, you don't like a company and you don't want to invest into it. For me, one of them may be Amazon. I don't like the fact that Amazon is exploiting their workers and making people pee in bottles. I don't want to invest my money into it. With an ETF, I really don't have a say in what companies are in these ETFs. It's all the way up to the fund managers. It's honestly all up to the fund managers, and you kind of did buy an ETF that contains these companies that are broad markets, that encompass the whole broad market. The only exception where you can diverge from this issue, where you can buy a whole broad market ETF and buy the whole market in general without dealing with like something that's unethical or immoral, and you want something more ethical, is GEQT, the G series, right? So iShares EGS, when you see EGS, that means ethical, sustainable, and governance. They basically invest into companies that are more sustainable and that align with like human rights and are much more favorable to just making sure the companies that they invest in aren't shady, right? And as you can see here, if I can recall last time I checked, Amazon is not in here, right? So if I wanted to support companies that are more humane, yeah, Amazon's not in here whatsoever, as you can tell, right? No Amazon whatsoever. None of those illegitimate companies that I don't like to support are in here at all. So that's the only exception to the rule, right? And that's really it with terms of like the bads of like buying a broad market ETF. Other than that, they're very, very good at what they do. They buy the whole market and they give you market returns. So basically, with that being said, again, what are these things, these VGQTs, XEGTs, GEQTs? Is there like a EQT or a GRO for every single letter in the alphabet? Is there like a BEQT or a KEQT or a JEQT? I should probably explain to you what these basically are. So basically, these letters in front of these EQTs, these GROs, these BALs, they generally represent the company that made these ETFs. So for example, Vanguard's ETFs that are made by Vanguard, which are founded by John Bogle, a historic and legendary investor in the investment world, made these ETFs. They are broad market index funds that are primarily invested into US and Canada, and the only difference between these EQTs, these GROs, and these BALs is the allocation of bonds. 0% in VEQT because it's invested all in equity and stocks. 20% in VGRO, so 80% is invested into stocks, 20% is invested into bonds. And for VBAL, which is 60% stocks, 40% bonds. And that's John Bogle, if you may have seen his photo on the internet. This is the legendary John Bogle that has helped a lot of people invest. On top of that, then you have these things called iShare ETFs, and iShare ETFs are just a branded version of ETFs that are made by a company called BlackRock, which was founded by a guy by the name of Larry Fink, another legendary investor in the investing world, and that's what he looks like. Just like Vanguard, they invest primarily into Canadian and US stocks, but with a lot of the BlackRock ETFs and their investments, they are slightly higher proportion into US stocks because they actually are a US based company, but they do offer their ETFs here in Canada. So with that being said, it's the exact same difference with Vanguard when you buy these XEQTs, XGRO, and XBAL. It's just the split of bonds. So in summary, for those that I hope that because we're nearing the end, I hope people have just a rough understanding of what I've been describing for the past hour. Investing means paying a price now for expected return later in the future. Stocks are ownerships in a company and its future profits. Bonds are contracts to be guaranteed payments in the future. ETFs are a collection of stocks and bonds on the market. When you're an investor and you want to start investing, you sign up with a brokerage and you put money into it to start investing. Depending on the investments you make, some brokerages may be better than others. Opening a registered account you ideally want to open a registered account first, and investing with it is generally ideal. That's generally ideal over investing with a non-registered account. And on top of that, investing into ETFs, you ideally want to invest into ETFs as they are often cheaper and help mitigate risk while maximizing gains, as well as just being overall convenient because you need to buy only one fund over multiple stocks, right? And if none of this information still makes any sense, just buy VEQT, VGRO, or BBAL. And that's literally the presentation. Does anyone have any questions? I hope everyone understands a bit more about investing in general. And now that they understand investing overall, to some degree, they are able to start investing right away and just buy these ETFs that ultimately get broad market returns. Oh, I should probably play some music in the meanwhile. Right, but I don't want to get copyrighted. No copyright. Background music. Wow, okay, that was a bit too loud. Okay. I hope that's okay. So yeah. So if anyone has any questions about investing, I'm definitely down for it. And if you want me to explain anything a bit more about investing in general, and maybe some just curious questions. Oh, you can't hear the background music? Shoot. Right, it is a bit low. Okay. So, with that being said, okay, I hope that background music is just a bit more louder. Yeah. Okay. So with that being said, like I said, or like I've been posted on the video, description, I have been investing myself for quite a while. I have been investing for roughly 3 or 4 or 5 years, 4 to 5 years, and I'm a do-it-yourself investor. So I've kind of learned a lot of these terminologies and these investment strategies overall by myself, without really any formal education in financing, business, investing in general. With that being said, being an engineer myself, I am able to look and investigate into academic papers and what experts say, and the math behind what they say, to actually have a clear understanding of investing in general. And while I used to do what I just described in investing, which is just buying BEQT, XEQT, all that jazz, I do something a bit more advanced than what I just posted for just slightly more games. I will probably save that video or a live stream of that on a later date to explain something called the Fromm-French 5-factor model investing, or 5-factor investing. That is very, very complicated, and ultimately you do have to understand something called statistics and calculus to understand how that type of investing works. But everything I outlined here is very basic that any person can do right now, start investing and to make some pennies in a safe and responsible way without buying GameStop and getting into short squeeze and getting into subreddits where they bet their money away. Right. So, with that being said, what I could probably show is maybe like what I could probably show is, I guess, other things too. Like maybe if people were curious on how much Vigro has in terms of its in its ETF, maybe I can show then, or Vigro is fine, but Xgrow is fine, but Vigro is also fine too. So Vigro here has, like I said, around 20% bonds, 80% stocks. When you look into these allocations, asset allocation here, you can clearly see, yeah, it's basically 80% stocks, 20% bonds. This 0.03% pretty much generally means cash. So what it means is that, like, these are the distributions of your assets. And so if we were to graph, yeah, no, it's fine. It's probably a good idea. Okay, so if we were to go into portfolio visualizer, and what we were to do is we were to check how well XEQT and VBAL does in relationship with each other with bonds. We can see the effects of bonds on each portfolio. So for example, this is from a historic. Wow, they saved my cookies. Okay, so if we buy XEQT and XGrow and XBAL, and we wanted to see if we invested into each one of these, our investments of $10,000 between the years of 1985 to 2021, and we wanted to see how these grow, we can see the effects of bonds on these portfolio. So okay, since XEQT was made around like September 2019, we can only go back up to a certain point in time. But we see here that here, portfolio 1, again, remember, has XEQT. At the end of this all, with XEQT, we would have made a sweet $11,000 and $11,000, $641 if you invested $10,000 only once, right, when it started off. On the other hand, if you bought in XGrow, which has 20% bonds and 80% stocks, you would have made $11,000, $535. On top of that, if you bought XBAL and you wanted 40% bonds and 6% stocks, you would have made $11,000 and $253. So you can tell here that bonds affect your portfolio because it reduces returns, but it also mitigates a lot of swings in your portfolio, right? So here, portfolio 3 represents XBAL, again 40% bonds, and from January 2020 to April 2020, when the stock market crash happened, you can see here that the person with 40% bonds lost $600 less during the crash of March 2020, right? As the stock recovered, because you have bonds and you don't have stocks, what ends up happening is that because 60% of your portfolio is stocks, you don't get the gains direct as much as you did with XGrow or XEQT, which has more holdings in stocks, and so your gains aren't as high. So while your losses are minimal with more bonds, your gains are minimal as well. It smooths out that curve, like I said, right? So when you're looking into investing, you have to understand your own risk tolerance. Basically, how much can you stomach seeing your portfolio, your investment going down? If you can't really see it if you can't really stomach it that much, ideally having bonds in your portfolio by buying XGrow or XBAL is a good idea. But on the other hand, if you're not that type of person and you're not willing to lose $600 more off of $10,000, if you're okay with that, yeah, buying XQT is fine. Also, when you have more money than just $10,000 invested, like let's just say, $100,000, that dip of $600 becomes $6,000. If you had $100,000 invested, would you be okay losing $6,000? Some people may not be able to stomach that. What if you were a millionaire, right? If you were a millionaire and you would invest your money into XBAL, you'd only lose roughly $170,000 during, not $170,000, but no, $103,000 during the crash of March 2020. But on the other hand, if you invested into XEQT, right, which has 100% stocks, again, the blue line is XEQT, instead of losing $107,000, you would have lost $68,000. So the more money you have, the more money you lose. And so generally, when the more money you have, the more you want to get into bonds to mitigate your risk because you already have so much money. If you have less money and you have $10, $100 invested, what's the difference of $6, $7 going to make to you? Not much. So when you invest into the stock market, how much money you have invested should sort of dictate maybe where you invest your money into. And also your risk tolerance and how much you can afford to lose. If you can't afford to lose $6, then buy XBAL. But if you can, buy XEQT, right? As well as that, with that being said, Portfolio Visualizer, this website here, is a great place to be able to compare the type of portfolio that you want to buy with a relationship to another portfolio you want to buy. So let's just say you want to buy a blend of BEQT, right, with XEQT, and instead of 100%, you want it to go 50-50, and maybe you wanted to go 100 somewhere else, right? if we analyze this portfolio... Oh, whoops. My bad. If we analyze these portfolios, you can see that having a blend of these two stocks may be good depending on what you want to do. I would not recommend buying XEQ and QT together, even though they're both really good, because they kind of do the same thing. But you could do it if you want. If you had like maybe $100,000 too, you can see the pronounced difference even a bit more, right? So with portfolio visualizers, when you get more into like investing and you get more into like buying ETFs of specific sectors you want, using portfolio visualizers to backtest your portfolio is pretty freaking important, because it gives you an idea of exactly how your portfolio may have done in the past, even though the past is not an indicator. The past returns do not indicate future returns as well. So, you know, there's that to it. Any questions with regards to understanding the basics of investing? Yeah, okay, I needed that drink. Okay, I think there's maybe one thing I can probably do to show everyone with regards to investing. If you are looking to invest and you are looking to get tools. Oh, tools. Any other tools of trade you're willing to go over for this episode? Yeah. So I would honestly go on some of my accounts to show how Wealthsimple and Questrade works. The only problem is, you know, privacy concerns, because if I give out my account number, that's not good, you know, because that is my investment. But what I can do is I can help people understand maybe other tools that they can use in order to analyze data and stocks. So one example, one good place to actually do that is actually Yahoo Finance. Yahoo Finance is actually quite good in giving you near up-to-date data on stocks and bonds that are live on the market at the current moment, right? So let's just say I wanted to buy the ticker symbol SPY, SPY. You can literally just tap it up and it gives you all the data that you pretty much need. You can look at the stock price during a time period of 1 day, 5 days, 1 month. Oh, I should probably zoom this in. 6 months. The year to date, starting the calendar date. A year backwards, 5 years, or even since its inception, right? Yahoo Finance is pretty good at doing this. And I mean, if you also want to look at historically how the market's kind of been doing, and you want to see where the ups and downs have been, you can see that the ups and downs that have been appearing are historically related to the events that happened. The dot-com crash of the 2000s, the global stock market crash of 2008-2009 with the giant dip, stock market crash of March of last year with the pandemic. Those are all pretty much here visible. On top of that, Yahoo Finance is pretty good in giving you other data, such as previous close. The previous close is the price that the stock closed at during that day. So for example, if we look here, the previous close was $408.52. If we go to track the last time period, it's pretty damn close. It's $408.49. The previous and the open price just means like the price that the stock opened at. So if we again go to the day, April the 9th, and check the date, it's it's not really there, but it's close. It is $408.83. Bid just means how much people have sold the index for. Ask is and the quantity, so 2200. Someone sold SPY at $410.77. 2200 of stocks of these, or units of these securities. Ask just means how much people are willing to buy the security for. So people were willing to buy SPY at 900 units of SPY at $410.96. The A range just gives you the maximum and minimum number of the price of this security within that given day. 52-week range is basically the same thing, but within that 52-week range. So if we look in for a year, the lowest price should be pretty close, right? So the lowest price given by the 52-week range is $271.41, whereas this graph here, the lowest number it can give us, by the looks of it, is $278.20. The volume tells you how much volume there is being traded, but the average volume is how much is traded on an average basis. The net assets just refers to how much money overall is invested into this ticker, SPY. I'm exactly not too sure about the NAV. The PE ratio is the price to earning ratio. That is a bit more complicated. Yield is also a bit more complicated. Year to return daily total is basically the ROI, but for that year. So if you were to invest, so the year-to-date total return, year-to-date daily total returns means that, like, if you were to invest into the SPY starting a year ago, and you were in the future a year later, your daily total return of the stock would be 8.86%. The beta is pretty technical. I really don't want to get into it. But it pretty much means how much the market fluctuates, or how much this ticker this security, this ETF, fluctuates in response to the market, and it's a 1-to-1 ratio. So if the market goes up by $10, this ETF will go up by $10 as well. But it's because this ticker, this ETF, ticker symbol SPY, does track the market the best it can. So it makes sense that the beta is 1. But getting into more technical into it is probably not ideal. There is the expense ratio, which is what I've talked about before. It is the MER, the amount of money per profit you have to pay to the person managing this fund in order for it to, for them to have a salary. It is not 9%, it is 0.09%, right? And the assumption date just tells you how long it started since then. With that being said, that's really all you need. You can go to charts to get a more in-depth detail of it, version of this chart. I really kind of don't bother with that. Conversations is just basically Yahoo Answers, but on Yahoo Finance. Historical data gives you lots of actual data of how much the data, what's the price of the fund, the security you're looking at, the price, how much in terms of volume the ETF or the security you're buying have been sold, which gives you a rough indication of how important and how well sought out these ETFs are, and how valuable they are to investors. Profile just explains you a general rough idea of it. These are all the option calls that were put on SPY. Holdings will be, of course, they tell you kind of exactly what percentage of these companies make up SPY, this ETF, the security. So in this case here, the top 10 holdings make up 26 99.92% of the total holdings in tickers in SPY. That is Apple, Microsoft, Amazon, Facebook, yada 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 yada. And the performance. Generally, you also you'd like to look at this too, because it gives you a rough idea of how well the fund has done over a certain given time period. And here it also gives you the annual return. So you can see here for 2008, during the housing crash, the S&P 500 did drop a lot. For the dot-com bubble, it dropped the S&P 500 and the SPY ticker for 3 years straight in a row. Pretty nuts. But as you can tell here, like when 2020 we had the March market crash, but it's still up by 18.4%. So, you know, when you're looking at a stock, the annual total return isn't a good indication necessarily of how well the stock is. You have to take a lot of consideration, like what happened during that year. What major events caused like gains and losses during that time period, and did those investments that you looked into were they affected by the events that happened around the world or within that specific like sector or economy? You know, all the type of stuff you have to look into. And risk, like, I really don't look into this because I kind of like as a DIY investor, I don't really look into like the numbers way too much, but these numbers are quite important for someone that wants to be more involved into investing. Alpha, beta are probably the most important out of all of these. The Sharpie ratio is also pretty important, but that's another story for another day. It is, again, involving math, calculus, statistics, and I don't want to get into it in this video, you know. So yeah, Yahoo Finance is pretty good if you start out with investing, and in fact, I think it's, for the most part, for 99.9% of people, it's really all you kind of need. Anything else is kind of like ridiculous. So with that being said, again, if everything has kind of just floated above your head through all this talk about numbers, financing, stocks, and bonds, there's only one thing I think everyone just needs to buy. If you are that type of person and you don't have any idea what to do, if you're Canadian, buy VEQT, and if you are American, buy VT. That's literally it. Of course, buying VTI is still fine too. And wow, that jump is kind of nuts. Wow. That was just for today. Really? Whoa. It jumped up 33 cents. No, 36 cents. 37 cents. Wow, it jumped up 37 cents. Just today. Oof. That run up too. From last year? Oh, from the middle of March. Yikes. That's good, but scary too. Yeah, like Vanguard's pretty go. For 99% of people, if they just bought VEQT or VTI, depending on whether or not they're American or Canadian or American respectively, they would be financially set for the next like 20 years. And I'm not joking on that. If you can't buy it, that's completely fine. As long as you can work your way to save up enough money to invest into the stock market and buy these ETFs, you are setting yourself up for success for retirement. Guaranteed. And oh yeah, just I think I didn't mention this, but Vanguard Total World Stock Index Fund basically mirrors what VEQT does, but it's more specified for Americans. So actually, if you look into the ETFs and its holdings, and portfolio holdings. We see here that they own in BT, well, not 9,000, but just right under it, 8,901 stocks of all these major companies. And you know, they are major companies that play a big part in the market. So you don't have to buy them individually, you just buy this one whole fund and you just get them all, right? All for a fee of, if you're American, 0.08%. And I think that's also one thing that I left out during the presentation that also probably would be nice to know if you do start investing too. If you're American and you want to invest, is actually very cheap. Like these ETFs, the expense ratio is pretty damn low. Yeah, STONKS, I know, right? Anyways, hey Adam, what's up? But yeah, like if you're an American, buying and investing into stocks is good. The only issue with buying into stocks is the high floor price of like these funds. BT is $100. Not everyone has $100 lying around to just buy one share of BT. But if you do start investing, you eventually will have to pay someone, obviously, to manage these funds for you. And with an expense ratio of 0.08, that's a buttload better than Vanguard, which has an expense ratio of 0.22. Right? It's not that much still. But like, for Americans, you guys are really, really lucky. If you invested your money and put your money into the stock market, like, you don't really have to pay that much fees. And on top of that, like, when you buy stuff like VT, you're investing into the whole market in general, right? So if we look at here, like, we see the distribution. 60% of your stocks are in North America, 16.6% are in Europe, 12.4% are in the Pacific market, 10.3% is the emerging markets. Generally, the emerging markets are considered company markets like China, Asia, some Asian countries, sub-African Saharan markets like Nigeria, South Africa, and less popular markets that don't make up a majority of the global market, right? Those are considered emerging markets. Middle East is obviously Middle East. And others generally means cash, right? So investing into stocks, when you invest the broad market ETFs, if you look at their fund page, you can see the portfolio composition, the companies that are invested based off of those that composition. You can see how much money that fund manages. In this case of BT, they manage $25.7 billion US dollars, right? On top of that, when you look at VEQT, they manage $795.57 million. Then again, VEQT is Canadian listed and is for the Canadians, while VT is for Americans. So it makes sense that with America, because they have more people, there's more money to be sent around and to invest, right? So that's one thing about investing with ETFs in America. If you buy American ETFs, you do get it for pretty cheap, and you just get as well as the diversified portfolio. Even though these two funds are managed by the same company, they do pretty much the same thing. And because you get it cheaper at in the US at a fee of 0.08, if you can buy the US version without paying like massive foreign exchange fees, do it, I'd say. On top of that, I didn't dwell too much into registered accounts as Canadians, but if you're a Canadian and you have an RRSP, if you buy American listed securities or ETFs in your RRSP, you actually do not pay foreign withholding tax, which is taxes that the US takes because you're an investor outside of the US. When you invest into an RRSP, you avoid those foreign withholding tax. But if you were to invest into a US listed ETF or a company or a stock in your RRSP, I mean in your TSFA or your taxable, you would get charged foreign withholding tax. And foreign withholding tax is 15%. So if you made any tendies and with US listed stocks or ETFs in your taxable, on top of getting taxed, you would get taxed 15% of your income, and some of that money would go to the US government because you're a foreign investor, not in the US, and you invested with your taxable account in Canada. So there's that. But getting more in depth into the different types of investing accounts that you can sign up with all these brokerages and how they play a part in your investment portfolio is a complicated matter because it involves a lot of taxes and a lot of laws. You do have to be aware of a general few so that you mitigate your losses due to fees and taxes. But for the most part, like, it should not affect your investment strategy nor what you invest in. Currently, I'm invested like a majority of my money into BEQT. If I invest my money into BEQT in my taxable, on top of like when I sell this BEQT, when I get taxed, I'll get taxed. Whenever these BEQT pays dividends, I will also get taxed as well in terms of capital gains tax if I invest in my taxable account. If I do it in my TSFA, I don't. But even with that being said, taxes and fees should not change your investment strategy. All it should do is just reallocate what you invest where, right? Because sometimes you may not want to just invest into BEQT, and you may want to buy ETFs that are US listed, right? You would ideally want to buy them in your RRSP so that you avoid foreign withholding tax. And again, that is another discussion for another day because it's kind of complicated. And I do want to stick to the basics for this video. Okay. Wow, it is getting late. It is almost 10. I think I will have to take a break, and just chill for a little bit because I was actually preparing these slides for like an hour or two before the stream just so I could get what's it called? A bit of preparation with showing these slides and just introducing stocks in general, because I know investing itself is a pretty scary subject because there's a lot of education about and misinformation about investing in general. But once you get to the gist of it, it's not really too bad whatsoever. Okay. In any case, I think I probably should go because it's almost 10. I probably should eat. Thank you guys so much for watching, and peace out. If you have any more questions with investing, please feel free to hit me up on Discord actually, or Twitter, and I'd be glad to explain lots of these terminologies and maybe what to do with investing. Anyways, peace out guys, adios for watching. Thank you guys so much for watching. Peace. Anyways, see you see ya Adam, see ya Spicy, see ya Pretentious, see ya Aaron, see ya Replicate, adios. Have a good day. Bye.